Batra. We're speaking today with Rajiv Batra, Chief India Equity Strategist, Head of Asia, JPMorgan. Rajiv, pleasure as always to have you on the show, and thank you for coming in. Let's start with the very, very positive and optimistic sounding view you have for first quarter in terms of earnings.
Thanks, Samanna. Good morning. Thanks for having me over here. So we do expect that after a very lackluster FY25, things will start turning from this quarter onward. Maybe you will not see in the bottom line result over here, but when you will hear the corporate commentaries, and even when you will try to compare the result with the consensus, that's where the surprises are going to come. So we do expect a lot of beats around, taking into account that going into this result season, consensus have been super bearish in terms of expectations on earnings. Usually that trend plays out in third quarter and fourth quarter when you are coming to the end of the fiscal year. But this time around, we are seeing it start of the fiscal year itself only, where expectations are quite anemic in both first quarter of fiscal year as well as from the second quarter. So I will not be surprised that despite you having a base effect advantage, analysts are not pricing that in yet.
Rajiv, that's an interesting aspect in terms of the overall analysis. But, from the entire note, what stood out is your Nifty 50 trade base case target of 26,500 and a bull case target of 30,000 over the next 6 to 9 months. How strong is the probability of then sustaining, according to you, above those 30,000 levels? And what gets you to this kind of a number?
So obviously there are two factors in play over here. One, earnings, and another one is valuation. Right now, taking into account of earnings, market are still in the mode of expecting close to mid-single digit kind of a growth number only. Market is not yet pricing in on 12-month forward term a double-digit number, or even I will say a lower double-digit kind of a number. If your EPS estimate for the Nifty 50 or MSCI India move towards targeting 10 to 12% kind of a 12-month forward earning growth number, plus a marginal re-rating in an environment where policy have been too supportive overall, that takes us to a 30,000 kind of a target. But the caveats over here is you need the double-digit growth handle, which will be very much a story of second half of fiscal year 2026. And you need a policy support continuation. I know India trades at an expensive valuation of around 21.7 or 22 PE, but in case if policy support continues and growth makes a comeback, there will be very strong chance that market even trade at 24 PE too, which is not different for India. If growth makes a comeback, people are more than happy to pay even higher valuations.
Good morning, Neeraj here, and thank you so much for talking to us. It's always a delight to do this with you. And maybe you're right? I mean, we are looking at the average multiples for the last 5 years. Post-COVID, India's virtually traded at 24 times. So, I mean, we can ignore the previous decade, if you will. My question to you is, this earnings growth optimism, where does it stem from? I mean, which sectors or which themes will effectively drive the Nifty earnings? Or do you believe that the earnings growth will not be necessarily in the Nifty 50, but would be at the broader end of the spectrum?
Thanks, Neeraj, for having me here. And I will say that it will be from a broader spectrum rather than just top 50 only, and some bit of it color you saw last quarter, where your broad index delivered you only 6% kind of an, the large cap index only delivered for you 6% kind of an earning growth. But when it takes into account small and mid cap, your earning growth was ranging in the almost in a broad range of 12 to 16%. That is coming on the back of your liquidity addition into the market, plus borrowing costs going lower. But is that indicator or are that indicator fully into the price overall? Answer is absolutely no, it is not in the price. So domestic indicators like favorable monsoon, borrowing costs being lower, ample liquidity available over there, plus the macro indicator, at least 50% of that improving. Are they in the price or in the number? Answer is not. I will even take a one step further and say, even if tomorrow, let's suppose there is an interim trade pact between US and India or a trade deal happen, is it in the price? Answer is absolutely no. The reason is very simple. If you look at India performance post Liberation Day, we are underperforming EM and Asia benchmark. despite the absolute return. Even if you look at our US exposed sectors like IT, auto, materials, and pharma, they are underperforming to their counterparts or peers in Asia who are up 16 to 18%. So there are a lot of positives which are not in the price yet. And maybe it is due to the last 4 quarters, we have not seen any positivity. Hence, consensus is more cautious this time around going into the earnings season.
To hear a bullish voice, viewers, you are hearing one right now. And with rationale out there, Rajiv, completely buy the argument that because of the pessimism over the last few quarters as well, in some sense, we are finding it difficult maybe to look at positive factors too, and the macro and the CAD, etc., are all positive too. One word, Rajiv, on flows, because you have the great handle on what could happen to flows. Right now, to your mind, this whole dollar weakness that has happened, or investors, the US blue-blooded investors talking about moving to India. I mean, we heard Jeff Gundlach talk about it, right, last month, saying that buy into India, forget it for 30 years, etc. You would be talking to a lot of these global investors, right? They've been amiss from the Indian markets because of high valuations. You think they move to India in any time in the next 6 to 9 months?
So I've spoken about of this lot on your channel and other places also, but investors comes to India not for valuation. We have never been in the past the value market. Even in future, we will never going to be a value market. Investor comes to India in search of growth. Growth was missing in India for the past 4 quarters. We average around 6 to 7% earning growth. GDP in one fine quarter was even less than 6. But if growth makes a comeback, valuation will not be questioned at all. Investors will make a comeback. But you hit the nail on head that are we seeing rotation in play? Absolutely, yes, it has started happening. There have been close to around $10 to $12 billion of inflows into emerging market, but not through active mandates, largely through the passive mandate. The reason behind is when investors are looking for diversification from developed market to EM, initially they are chasing through beta. Once the beta trade get exhausted, you will start seeing money being allocated to active manager in search of an alpha. Right now, EM is a beta theme. On that, some of the bigger boys have started benefiting. India will also join the bandwagon. It will be unfair to say that India has not seen inflows, because when we look at India equity net inflows, the number has moved from minus 16 billion net outflow in April to now close to minus 7 billion only, which means we have seen 9 billion inflow in Indian equities over last 3.5 months. But is it fair to say everything secondary market enjoyed? Maybe not, because we have seen a lot of new paper arriving, and that has also absorbed a lot of flows. But are we going to see more inflows coming? Absolutely yes, because since 2022, the whole emerging market are still at a net outflow of $50 billion. Top of it, despite having EM benchmark weight of 11% in the index, what is the global investor allocation? 4.6. But with growth slowing down in DM, especially US, which is a bigger benchmark, in search of a higher growth, I'll not be surprised in coming 2, 3, 5, and 10 years time, growth will start being chased outside of the US, be it in EM, Europe, Japan. This will be the territories where more inflows are going to come from US denominated benchmark.
Absolutely bullish tone, in terms of emerging markets. And then when you look at India, when you're talking about growth versus FIs, not looking at the valuation side of it, where is that money going to come into? Which sectors would you be chasing?
Definitely, I'll go with the domestic demand because the environment is quite supportive for domestics to do well. Indicators are also showing in this direction versus the export-oriented indicator. So sectors like banks, consumer, auto, then healthcare, which is largely a hospital, real estate, defense, and power. These are the spaces which are going to be chased for higher growth, compared to your global exposed sector, where valuations are not that attractive enough, and growth is also in a low single digit or a mid single digit kind of a levels.
Rajiv, I'm just wondering if you see any, I mean, we've seen some volume impact, but you see any impact at all of this whole Jane Street saga in terms of souring of sentiment of global investors towards India, or you think it's going to be, just a passing phase?
So if you will look at the markets right now, markets listen to what the regulators are doing. So if regulators are trying to take a call of getting rules and regulation better in place overall and not letting any of activities which are not in line with the principles overall. Foreign investors or even be it the domestic investor, they always appreciate. So I'll say, like, if SEBI is doing a great job in terms of managing things around to see how situation is being panning out in terms of flows, in terms of the daily volume activities over there. So I think most of my foreign investors do appreciate, because the only complaints I have kept on hearing when it comes to emerging markets, be it India or any other countries, is that people question that we get a very good guardrails in developed markets like US. What about the emerging markets? So if that start becoming available through the regulator side, the story gets much more favor from the foreign investors.
That's a great way to put it, that if there was any question about guardrails in emerging markets, well, then look at SEBI. SEBI would be, frontline in terms of a regulator and the action they've taken. Rajiv, just, coming back to what you're finding exciting in India and in the backdrop of what we've seen with TCS, IT, all of the confusion about trade tariffs, the India deal is not inked yet. Do you think IT continues to be a spot of vulnerability?
So we have downgraded Indian IT to underweight post last result season. And the reason was exactly that you cannot trade at a +1 standard deviation valuation when your 12-month trailing earning growth is close to 3%. The situation applies same for Indian IT sector, what FMCG has gone through for the last 5 years. That if somebody cannot buy FMCG 40p at less than 5% earning growth, how one can look into IT sector with 25p and less than even 5% earning growth. The AI headwinds which are approaching to them, plus the demand slowdown outside. Remember, we are not saying that US is going into recession, but at the same point of time, exceptionalism is also not there in place. So slowdown will definitely impact the top line also. Taking all these factors into account, we don't feel the investment environment is too conducive for IT space over here. Yeah, a trend which has been happening going into the earnings season 1 month before Indian IT sector rally, and when you are amidst a result season, the IT sector starts seeing sell down. We believe that trend may continue because of the kind of a trading pattern the sector has been for the last couple of years.
Just very quickly, as we wrap up, Rajiv, consumer stocks, staples making a comeback, pharma now no longer just a defensive play?
So yeah, we do believe in the rural recovery. We have started seeing green shoots around, and whenever the conversations comes about rural recovery, it's like glass half full, half empty. We are being more optimistic, and we are seeing it half full, and other half may get completed by somewhere in next 2 quarters or by end of this year. But yeah, that has been the poster child of consumption recovery, which is coming into play overall. Plus now your tax benefits, which have started clicking in from end April, plus 8th pay commission approaching overall. It is making a quite an interesting environment for the whole consumption space. Besides the margin advantage which they get due to easing inflation overall, and even the commodity prices being lower too. So they will definitely enjoy. In case of a pharma space, yeah, there are a lot of moving parts to watch. One definitely is the end demand that is in US. And the other space to worry about is what's going to happen in pharma tariff. Although after hearing the US administration comment that it could be 200% tariff after 18 months, that's a long gestation to even get worried. So I will say one need to be still selective in the pharma space. From our end, we still like domestic pharma names or pharma names which gives you a huge exposure to the GLP kind of themes.
On days like these, when the market sentiment is bad, it's great to hear such a bullish voice. And if some of the stuff that you've spoken about, even if part of it turns out to be true, that'll be great for Indian markets. Thank you so much for sharing all of this with us. Lovely reading your note yesterday, Rajiv, and thanks for talking to us today.